One of the key issues, I think this has already been addressed by others, that we really need to look within Africa itself, but also internationally, to see how we can bring the different strings together to address some of the key issues that we are facing now. But particularly in terms of debt and the high cost of credit, we need to first of all look within Africa. Why is credit in Africa that expensive? It is very high. There is lack of competition in the banking sector. There are few suppliers, and there are monopolistic tendencies that could be a driver to the high cost of credit. Moreover, there are high rates of non-performing loans, not least because the rates people borrow at are very high, and these justify the high rates and therefore the spreads between what banks receive as deposits and what banks give out as loans to the different borrowers, and therefore increasing the spread, which is a key indicator not only within Africa but also internationally as to how this economy is particularly operating. There are also high operational costs for credit providers. For instance, we are seeing, or at least many countries have reported, that the cost of evaluating people applying for loans is increasing not least because of the governance structures in the countries, but also because of the availability or lack of availability of information on the potential borrowers. And this has increased the operational costs of the bankers. The other thing also is the high benchmark, the risk-free lending rate, against which the bank lending rates are calibrated. These actually stem from the regulations relating to bank lending rates, which link the prime lending rates to policy rates. And these themselves are very high. And because they are high, they in turn also affect the lending rates within the country. And then there are other regulatory requirements, such as reserve and liquid asset ratios. But let me move away from these internal within Africa issues and distill them into these high spreads that result from these factors, signal to the international community the risk perception of African countries, and therefore the terms at which these the international community is willing to engage with African countries around debt. In most cases, what happens is that when sovereigns go to international community to look for funding, what happens is they look to the credit rating agencies, who will point out in one of their operations that one of the key indicators that African countries are unbankable is that they've got a high spread, and that high spread is then causing them to increase the rate at which different lenders are willing to engage with African countries. Now, what happens is that at the sovereign level, the high interest rates are driven by several key factors. One of those is the liquidity squeeze within the African countries, not least exacerbated by the domestic financial institutions' preference to invest even the limited liquidity in foreign assets, and also the existence of illicit financial flows, which not only deprive the countries of the tax revenues, but also remove from countries resources that would have operated within the financial system and increased the liquidity in the country, so that this increase in liquidity could also depress the lending rates within the country, and therefore the cost of credit being lower. The other thing also is the excessive need to attract investors for Africa's development, that is forcing African governments to borrow short-term to finance long-term projects. The mismatch between the short-term duration of the debt that African countries have taken to, for instance, by issuing Eurobonds, compared with the long-term nature of the projects or the needs of the countries they propose to fund, with the money raised by the Eurobonds is also bringing a kind of stress within the African countries' debt dynamics. The other thing also, which stems from one of the things that has already been mentioned, which is the governance issue, is the fungibility, the flexibility with which they can be utilized for purposes other than the ones they were raised for, exposes these funds to downside governance vulnerabilities of misappropriation and non-productive expenditures. Lastly, when you look at the poor credit ratings that African countries attract, where a majority of African countries are still in the junk status, these credit ratings are pivotal in determination of both interest rates and the demand for bonds. And therefore, by them, especially the credit rating agencies, being skewed away from African countries' needs, not least because of their monopolistic nature and African countries not having lenders can look at, they make African countries vulnerable, and as such, vulnerable to high interest rates and such persistence of the high rates that they can engage with lenders. Therefore, African countries' debt management should follow the principles of effective governance for sustainable development. They should, in the minimum, ensure effectiveness, meaning that the loans that are contracted after careful analysis of their terms and mapping these with the purposes to avoid the mismatches between short-term loans being contracted for long-term purposes. There is need for operation within a sound, integrated national financing framework that maps properly the different priorities that countries have with the different sources of financing and the nature of those sources of financing. There is also a need for accountability for the processes of loans negotiation, which should be transparent and should be done with integrity and subject to independent oversight to ensure that the resources are used for the purposes that the loans are being contracted for are underpinned by the principle of leaving no one behind. And then non-determination, the process of identifying the need and the management of the disbursement of the resources also needs to be inclusive of other stakeholders. We're talking about civil societies, the private sector, as well as the public sector, with the clear consideration of intergenerational equity. I'll hand over back to you.
Mm-hmm. Mr. Mukungu, I want to hear a little bit more from you in regards to the extent at which this high cost of credit on the continent is contributing to the current African debt crisis, and also in general, the development, the economic development of the continent as well.
Thank you very much for this question. The high cost of credit itself is an issue for African governments. It's an issue for African governments in a number of ways. The first one is that they increase the debt service needs, and those debt service needs are prioritized by African governments over other expenditures within each country. And in so doing, therefore, they are constraining the fiscal space that countries have to consider other development needs. The high cost as well means that countries considered they would need to borrow later on further to service the debts that they have, because most of these debts are actually foreign currency denominated debts. It's only recently that we have started seeing an increase in local currency denominated debts, but they are mostly foreign currency denominated debts, and many of them are short term. So before the term ends, usually what happens is that there is a renegotiation, and this renegotiation is still done at these high interest rates. And those high interest rates then continue and escalate and accumulate to constrain the fiscal space further. So high credit costs constrains the fiscal space of African countries, and in so doing has got impacts on the development of countries or the ability of the countries to finance development.
Mm-hmm. Is there any hope at all at reducing the cost of credit in Africa? For example, the ECA's liquidity support facility, will that in any way help in the reduction of the cost of credit in Africa?
The Liquidity and Sustainability Fund is a special purpose vehicle to subsidize private sector investment in Africa's sovereign debt, and increasingly it is being considered by other regions of the world as well. This would incentivize rather than coerce private sector creditors to participate in initiatives towards creating fiscal space for African countries. The Liquidity and Sustainability Fund would provide concessional repo financing to private bond investors, and these investors would borrow from the LSF by pledging African sovereign debt, e.g. in Eurobonds, as collateral. Investors would finance their African sovereign debt holdings with LSF repo bonds. These cheaper loan terms should stimulate further demand for African sovereign debt and therefore lower borrowing costs. The LSF would be financed by, for instance, ODA or the MDBs, and by central banks of the OECDs. That's the kind of discussion that the ECA is engaging in. And it is good news that the SDR, the $33.6 billion SDR allocation has now been released. There are further negotiations to see how much more of the 650 billion SDRs can be reallocated towards developing countries to increase the allocation, for instance, to the African countries. So indeed, the LSF is intended to incentivize the private sector and subsidize them to ensure that they can borrow at better terms, and in so doing, they would enable the shaving of the high cost that African governments have been facing on the repo markets by lowering the cost of borrowing.
To read and sign the Harare Declaration, go to www.afrodat.org/initiatives. Click on Afrodat Conference on Debt and Development, and then read more. And finally, the outcome statement.